When it comes to passive income sources in Kenya, most Kenyans have this negative belief that rental income is the best source of passive income in Kenya. But then if you do the analysis, you're going to realize that we have other better sources of passive income compared to rental income that you can always exploit. So in this video, we are going to be looking at alternative sources of passive income and then comparing them, ranking them from number 5 to number 1, from the worst to the best, and then talking about their pros and their cons as well. So in this video, we're going to explore other passive income opportunities. So talk about coupons from infrastructure bonds, coupons from commercial paper, what we call corporate bonds, dividend income from dividend stocks, and also other passive income opportunities. So let's get right into it. I want us to start our conversation today by first understanding what passive income is and then highlighting the advantages of passive income. So whenever I'm talking about investing in financial assets like treasury bonds, money market funds, stocks, and other investment assets, most people usually come and say that maybe I can make more money by maybe investing in my own business, maybe investing in my farming business, maybe investing in my matatu business or any other business that they may think of. But then again, it's very important to highlight the difference between active income and passive income. So active income is whereby you are spending much of your time and much of your energy in following up that investment. So for example, someone, rather than investing in financial assets, you can start your own farming business whereby you have to spend most of your time following up how your farm is doing and trying to make the most out of that investment in that farm. But now for passive income, you have other people working for you. So for example, you can invest in a company like Safaricom and then you can make money through the dividends, because when Safaricom will declare profits, they are going to share the profits with shareholders, and through that you can make, or maybe you can earn a dividend, and that's what we call passive income. So passive income is any income you get without you having to necessarily have much of your input in it. So it's your money working for you, not you working for money. So it's very important for us to understand the distinction between active income and passive income. So passive income doesn't require a lot of your time. You can still be doing your 9 to 5. You know, if you're a surgeon, for example, if you're a doctor, if you're an engineer, if you're a lawyer, you can go about your day-to-day activities while your money, maybe in bonds, in stocks, in a real estate, is working for you. But now for active income, you have to actually input your attention and your time and your resources so that you can get the money. You can work for the money now. So passive income can be in form of many sources. For example, I mentioned a rental income from real estate. You don't have to do a lot of work. Once you have your unit set up, your tenants are going to be paying you on a monthly basis. Number 2, you have coupons from bonds. So once you buy a bond, you have the coupon that you're going to get paid every 6 months. Number 3, you have dividend income from stocks. So once you buy a stock that is a good dividend paying counter, you're going to get the dividend income whenever this stock registers profits. So mostly in Kenya, we get paid dividends annually, but some counters in other markets pay dividends quarterly or even semi-annually. But for Kenya, we get it annually. Then you also have your SACCO shares, for example. So your SACCO shares can give you dividends, and also your SACCO deposits can give you the rebates, and many other investments. Even money market funds can give you the interest on your savings as well. So those are examples of passive income sources. What is the importance of passive income in a portfolio? So passive income can be very important to different investors. For example, if you are approaching retirement, or maybe you are a retiree, you want to replace your active income with passive income. So let's say, for example, you have an employment job, or maybe you have some income whereby you're employed and you make 100,000 per month. So maybe after you have left employment, you want to be getting that active income, and you need to replace it with a source of passive income. So you need to invest some amount of money that can give you an equivalent of 100,000 per month for you to be able to maintain the lifestyle that you're living, for you to be able to maintain that same lifestyle in retirement. So that's an example of a use case of a passive income. Then number 2, there are people who are chasing maybe financial freedom, financial security, or maybe they want to reach a point whereby their investments are earning them more money than what their active income is earning them. So simply, your investments are earning you more money than what you are getting from your employment. And maybe that's a stage whereby you have reached a financial freedom. Maybe you're financially free because you don't have to rely on your active income for you to survive. So that's another use case for passive income. Then number 3, there are people who want to offset either some current expenditure or maybe some future expenses with passive income, so that maybe they don't have to worry much about those future expenses. For example, maybe you are intending to pay school fees 10 years from today, and you know that maybe these fees you are going to pay for the next 4 years. So maybe you can build up your savings or build up your investment. Then you can invest your money in, for example, an infrastructure bond, and then you can use the passive income from that IFB to pay for your kids' education. That's another example use case of passive income. Another example of a use case of passive income, there are people who don't like paying expenses like rental income, maybe car insurance premiums, maybe life insurance premiums with their active income, because maybe it's going to overweigh their budget, maybe stretch their budget. So maybe they can buy assets that can generate a passive income for them. Then they're going to use the proceeds of this passive income to meet these expenses. For example, you can meet rental expenses with passive income. You can meet school fees like I mentioned. You can even fund your travel kitty, maybe your travel expenditure from passive income. You can meet your life insurance premiums, maybe your car insurance premiums with the passive income. So passive income is very important. It has several use cases. So investors are always seeking opportunities whereby they can get a better return of their passive income. Now, since you have understood what passive income is and you have seen its importance, now I want us to look at the best sources of passive income. I'm going to rank the best 5 sources. So I'm going to rank from number 5 all the way to number 1. Then I'm going to give the comparisons, and then at the end we're going to discuss other asset classes that maybe I won't have included in the ranking. So let's start the ranking. Passive income opportunity that I rank at number 5 is rental income. So like I mentioned at the start of this video, for me, I usually find a real estate overrated as a passive income source, and I'm going to give my take about that. So for me, if you like to get my thoughts more about real estate, I've done a video about real estate that you can find here. So why is real estate overrated as a source of passive income? So number one, it's very important to understand that real estate has two return elements. So it has what we call the rental yield. So what a rental yield is, it gives you the return element on the cash flow you're getting from your rental income. So to calculate your rental yield, you should basically take your annual rental income, you subtract any expenditure, maybe if you pay taxes, if you pay any maintenance charges, then you divide by the market value of your investment. So for example, if you have a, let's say a piece of a real estate project, maybe some apartments that you have, maybe the market value, so don't use the value that you bought it, so the current market value, because maybe you bought at 16 million, it's at 20 million, so the market value maybe it's 20 million, then the monthly rental income, so maybe if your tenant pays you 100k per month, you multiply that by 12, so you get maybe 1.2 million, then you subtract any taxes or any maintenance fees, then you get the rental yield. So then the other second return element of real estate is what we call capital gains. So for example, you bought that property 5 years ago at 16 million, now it's at 20 million. So it has appreciated by a certain annualized rate. So it has two return elements. But now, whenever we are talking about passive income, we are only going to focus on one return element, which is the rental yield. So if you look at most real estate properties in Kenya, more so in Nairobi and within, the rental yields range between 4 to 6%. So as a cash, maybe as a passive income return, maybe as a cash return on investments, the rental yield is only between 4 to 6%. Yes, you can get better properties at 6 to 8% or even above 10%, but those are outliers. For those of you who maybe have some investments in real estate or maybe apartments, just do the net annual rental income minus any expenses, divide by the market value, and tell us in the comment section what is your average rental yield. So I would like to know that in the comment section, so maybe other people can actually confirm whether what I'm saying is actually true. So the rental yield is between 4 to 6%. So if you compare now that with other asset classes, that is quite lower, because bonds can give you 12%, corporate bonds can give you way higher than that, money market funds even can give you way higher than that. So that's the first thing about real estate. So the rental yield return in Kenya is good, even though some few real estate projects, maybe for example, if you have commercial property, if you have a very unique offering as a real estate project, and also maybe if you have a furnished unit like Airbnb, so they can give you higher rental yields. But the average person, the average residential units are giving 4 to 6%. It's actually even lower for guys who are outside Nairobi and the surrounding areas. So if you're in a remote area, like for example Nyeri or other areas, it can even get worse to about 3%. So I would like to get your reviews on the average rental yield of your properties. So the other cons about real estate, we have already seen that maybe the rental yield is not good, even though the total return might be high, because if you add now the appreciation plus the rental yield, you can get maybe a higher return. Here we are interested in the rental yield only, so maybe it's 4 to 6%. So the rental yield, or maybe the return, the passive income return, is very low. Then number 2, we have something else we call the occupancy rates. So in real estate, let's say you have 10 units, you have to know how many units are occupied for the whole year. So during the year, you may have some vacant units, or even throughout the year, you may have some units that will be vacant. So the best occupancy rate in our Kenyan market is anywhere above 85%. So if your rental units, or maybe if your real estate project has an occupancy rate of below 85%, then you're actually below the recommended value, and you're actually missing out on rental income, because for the vacant units, you're actually missing out on rental income. So the occupancy rates can be a headache, mostly if you're just getting started or depending with the location of your unit. So yes, you can have your money, you can have your real estate project, but then again, you're going to struggle with occupancy rates. So that can also lower down your rental income as well, or even make it a fluctuating passive income, which is not good, more so if you are, for example, a retiree, or if you're banking on that income. So occupancy rates will not always be 100%. That's the other con. Then number 3, for most of these real estate projects, most people in Kenya are financing them with very expensive loans. So for example, if you want to set up a real estate project for 20 million, or even if you want to buy an apartment for 8 million, 10 million, most guys are doing this using very expensive loans. And I think the other day on my Twitter and across my platforms, I did a very interesting thread that got a lot of views, whereby I was trying to explain that one of the worst things you can do in Kenya is to borrow to invest. So in Kenya, because the interest rates are so high compared to what the average asset class is giving you, it makes sense more to save and then invest rather than borrowing to invest. So now if you are taking a loan to invest in real estate, you have now to deal with the expensive bank loans. Now you can imagine taking a bank loan at 17, 18%, but now your asset class, or maybe your real estate project, is only giving you cash back at maybe 4 to 6%. So you can't actually use your rental income to pay for your mortgage or for your loan, because even if you take a mortgage from Kenya Mortgage Financing Company, which is probably the lowest at maybe 9% or 10%, and your rental yield is giving you 4 to 6%, you even can't use your rental income to meet the mortgage obligations, because the rates don't add up. Actually, it's like you're paying double for the mortgage, or maybe you're taking half the loan in return. The expensive loans as well. So most people will have to take expensive loans, and for other asset classes, you don't need to take expensive loans for you to set up. Then as well, the tax of 7.5% for rental income tax is high compared to other asset classes. There are some other asset classes that have lower tax rates for their passive income. So those are the bad things about real estate, but then it also has some good things about real estate. So number 1, the good things that maybe it also sees capital appreciation. Then number 2, if you're in a very good location and you have a very good deal, and maybe you have also furnished units, you can get above average rental yields of 10, 12%. Then the other good thing is that real estate is an asset class that sometimes withstands any economic conditions. So when the stock market is crashing, when bonds are having challenges, it can still prevail. So it's an asset class that has stood the test of time. So after rental income, or maybe after real estate, the number 4 ranked asset class in terms of passive income, I'm going to have dividend stocks, or maybe what you call dividend income from the stock market. So dividends can be a little bit tricky, and also if you're not well versed with financial markets, because number 1, you must know how to pick a good dividend stocks. Then number 2, you must know how to rotate between the dividend stocks, because for most dividend stocks, also in our Nairobi Securities Exchange, you must be very tactical. Maybe you must be a very tactical investor. Maybe I'm going to give the strategies. Maybe you can start with the advantages, maybe why I rank dividends higher than maybe, for example, real estate. So I'm going to give you a couple of reasons. So number 1, if you look at the dividend kings of the NSE, maybe the good counters for dividends in the NSE, you're going to find them having dividend yields of above 10%. So most of them are going to have dividend yields of above 10%. So what is a dividend yield? So whenever you're talking about dividends, don't look at the dividend per share. There's a metric that will help you look at which counter is the best for dividends. So you must look at the dividend yield. That's the first metric. Then you must look at the dividend payout ratio, and then you must also look at the dividend policy of the company. So let's break down these terms. So the dividend yield is basically the dividend per share. So let's say, for example, Stanbic or maybe Stanchart declared a final year dividend of 40 shillings per share last year, and then your average buying price, because maybe you have been buying these shares for a couple of years, maybe your average buying price is 300 shillings. So if you look at the dividend yield of that stock, it's going to come to 40 divided by the price of that stock, which is 300. You're going to get a dividend yield of 13.3%. So for most stocks, you can get dividend yields of higher than that, because if you look at another counter like BAT, for example, BAT last year, I think they paid a dividend per share of 50 shillings. if you bought maybe at 300 shillings, you have a dividend yield of 16.6%, for example. So that's the metric that we call the dividend yield, which is a very important metric. Then the other one is called the dividend payout ratio. So out of the profits that a company makes, they usually declare a certain percentage of that profit to be paid out to investors. So now, depending on the dividend policy of different companies pay out different ratios. For example, some companies like BAT and Standard, they pay about 85% of their profits, they distribute them to shareholders. But some other companies like Safaricom, the big banks, most of them may distribute lower percentages to their shareholders. So if you're looking now for a good dividend stock, you must look at a couple of things. Number one, you must look at your dividend yield, look for higher ones. You must look at also for stocks that distribute most of their profits as dividends to their shareholders. So the dividend payout ratio. Then the dividend policy and the dividend track record of a company, because in the NSE, there are companies that we know that they have a historically paid very good dividends, so they have a very solid dividend track record. So if you compare those 3-4 metrics, you're going to come with a list of the dividend kings of the NSE. So by dividend kings, maybe I can briefly explain that to be companies that have very good, solid dividend track records. Maybe are optimizing your portfolio for good dividend income. So I'm going to also attach a list of the rankings, most of all last year, so maybe you can see what I'm talking about. But then remember, the dividend yield is influenced by the price. So obviously now you can have some strategies whereby you can bring down your average buying price and as well raise your dividend yield as well, because usually after book closure, so book closure is the date after which if you're not in the registry, maybe if you're not in the shareholders book, you won't get dividends. So for example, if Stanchart closes their book today, investors who current Stanchart shareholders will get that dividend, but now if you're not there, you won't get that dividend for that current year. So most investors in the NSE usually sell their dividend stocks after book closure and then buy back because the price will go down. Then they usually buy back after some time when the price has gone down. So it's always good to buy dividend stocks after book closure and then maybe sell them as well before book closure to lock in the dividends and then also average down your price when the price goes down as well. With such a strategy, you can always do a cost average and bring your average buying price down and also bring your dividend yield higher. Why do I like dividends again? So number one, you can get a high dividend yield. Number two, you can have a solid dividend consistency, so every year. So rather than maybe waiting for the rental income whereby you are struggling with occupancy rates, and whereby maybe you are struggling with the headaches from tenants management, for dividend income, if you choose a good stock, you can actually get some consistency, because most of these companies like BAT and Standard, they have paid very good consistent dividends over the last 4, 5, or even 10 years. So that can help you out. Then the other thing, the tax incentive as well. So tax incentive for dividends is only 5% withholding tax. It also helps you save on taxes as well. And then you can also get some capital gains as well as a reward, because stocks you can make money in 2 ways, through the dividend yield or through the price appreciation. So now the total return can be impacted by those two things. So you also get a higher price, also a higher dividend, so your total return can also be influenced by that as well. So you also stand a chance of getting a capital gain as well. Then the disadvantages about stocks, number one, it can be a little bit complex to follow stocks and to know which stock to buy. More so, maybe most of you never knew that we have something called a dividend yield, a dividend payout ratio, or even a dividend track record. So now, if you don't take it from an educated point of view, you may miss out on the main points. Then number two, some companies may change out their dividend payout policies as well. Then number three, you may suffer significant capital losses that may wipe out your dividend yield gains as well. So your total return might be impacted by the price return as well. But generally, I will rank a dividend income as number 4. Now let's go to number 3. So now at number 3, maybe for the remaining ones, I'm going to be much brief, because maybe they are all under one major asset class, or what we call fixed income securities. So they are all different types of debt obligations. So at number 3, we have what we call fixed coupon bonds. So in the Kenyan government bonds, you only have 2 kinds of bonds. You only have the infrastructure bonds and the fixed coupon bonds. So the difference is infrastructure bonds are tax-free, and now fixed coupon bonds, now depending on the maturity, some fixed coupon bonds have a tax obligation of 15%. So if a bond has a maturity of less than 10 years, the tax obligation is 15% withholding tax. If a bond has a maturity of above 10 years, the tax obligation is 10% withholding tax. So why do I like fixed coupon bonds? Why do I like government bonds? So I like government bonds because number 1, the coupon rates for these bonds are actually high. So normally bonds can give you anywhere between 12 to 14% in terms of the coupon rate. That's number 1. So the yield is quite good compared to the real estate and compared to most dividend stocks. Then number 2, they are fixed and almost guaranteed returns. Unlike real estate, whereby you are struggling with occupancy rates, you are struggling with managing tenants, you are struggling with borrowing expensive loans, you have a lot of headaches for real estate. But now for government bonds, or what you call fixed coupon bonds, once you make your payment, let's say you have $1 million, once you buy your bond, let's say it has a maturity of 10 years, and it fetches a coupon of 13%, you are going to get that coupon. Let's say, for example, after taxes is going to be maybe 125,000 or 120,000 after taxes, because it's 130,000 before taxes. Then after taxes, if you can just try and do the math, actually 0.90 times 130,000, if you are assuming a 10% interest rates, it comes to 117,000. If it's that 117,000, then you divide by 2, that comes to 58,500. So if it's that 58,500, you're going to get that 58,500 twice per year. So maybe in January you get that 58,500, and then in July you get that 58,500. So you're going to get that 117,000 every year until the maturity of that bond. So until now, the 10th year where you get your money back. So there's that fixed and almost guaranteed return, because our government of Kenya has never defaulted on debt. So unlike real estate where you are struggling a lot and you have to do a lot, for bonds you just have to wait on your bank account and you're going to get the notification that you have received your coupon. So it's much hassle free. You don't have to do a lot of work. It's actually your money working for you, literally. Real estate, you have to do a lot of work. Dividend stocks have some risk. Maybe government bonds have lower risk as well. So number 1, good return, less hassle, less headaches, conservative risk as well. You don't have a chance of losing your money because the government of Kenya has been quite stable, never defaulted on debt. So I like that. And then as well, the coupons are paid twice per year, unlike now the dividends that are paid once, maybe annually. And now unlike the rental income that maybe is paid out 12 times per year, of which sometimes you may have some vacant units, and sometimes some tenants may have challenges in paying rent. So for government bonds, it's much more straightforward, much more easier. The disadvantages about government bonds: number 1, price returns sometimes can be limited. So maybe you don't have much price upside unless maybe you sell in the secondary market. Now it depends with how that bond is trading in the secondary market. So maybe the total return is only the coupon rate, not much a price return, but that can be subjective. Some bonds can fetch higher returns in the secondary market, others can fetch lower returns. But ideally, for passive income investors, we are buying to hold for the long term, not to sell. Then number 2, the default risks are there, but for local debt, it's very hard for a government to default on local debt. I know some of you guys are going to tell me that, I think, was it Ghana that when they defaulted on their debt, they first defaulted on their local debt. In very few instances it can happen, but normally it's very hard. So for example, the Kenyan government, they can easily print more Kenyan shillings rather than defaulting on debt, even though it has economical consequences. But it's very easy for them to default on external debt, for example, Euro bonds, because you can't print more dollars. That's it on fixed coupon bonds. Let's look at number 2 and number 1. At number 2, maybe most of you will have guessed it, I have infrastructure bonds as the second best source of passive income in Kenya. Actually, I will have put it as at number 1, but maybe due to maybe having a better source at number 1, maybe I'm going to put it at number 2. And I'm going to explain why. So I think I've already explained why I like bonds, government bonds. So now the only reason why I like IFBs more than fixed coupon bonds is that the reason that they are tax-free. So they are tax-free, and then they also carry the other benefits of fixed coupon bonds, that the returns are almost guaranteed, they are predictable, hassle-free, they are tax-free now, low risk, conservative investment approach. So it's the best shot that you have at passive income. So if you're that person who really likes passive income, mostly if you're a retiree or maybe someone who is approaching retirement, bonds can help you get a very consistent and predictable passive income. Mostly if you employ a strategy that I called bond laddering. I think I did a video on bond laddering that I'm going to attach here. So if you employ bond laddering, you can get a passive income month on month from your bonds portfolio that can replace your active income or maybe your salary. So I want to talk more about infrastructure bonds because I think it's the same as fixed coupon bonds, only that now IFBs are tax-free. The benefits and the disadvantages of fixed coupon bonds carry on to the infrastructure bonds. Maybe the only disadvantage I'd like to talk about infrastructure bonds is that they are not easily available for CBK. So CBK floats infrastructure bonds almost once every quarter. So usually have like 4 every year. So you don't have a bonds calendar. So CBK had released a calendar, but nowadays they don't even follow it. If you have been an investor, you can agree with me that they usually have about one IFB every quarter. So if you are relying on the CBK website or maybe the 1000SD, AIFBs may not always maybe frequently be floated. You have to wait maybe every quarter to get the ones that are floated, but you can always get them in the secondary market, even though sometimes you may be played by your broker, or maybe your broker may take advantage of you, and the pricing might not as good. That's why maybe I don't recommend sometimes buying bonds from the secondary market, but in most cases you can still wait for the IFBs being floated by CBK. So now let's go to number one. So the number one source of passive income, I know this will be a surprise to many. Maybe it's an opportunity that most of us can't access, but it is what we call commercial paper, or what we call corporate bonds. So corporate bonds are just the same as government bonds. The only difference is the same way we have the government borrowing money, even companies can also borrow money from investors. So for example, Safaricom can be looking to raise money because companies essentially fund their activities in two ways. They can either issue equity or they can have debt. So the main funding models of major businesses, it's either equity or debt. So now a company like Safaricom, or maybe any other company, might be looking to raise capital, and they can issue a corporate bond, or what you call a commercial paper. So the good thing about these commercial papers is most of them have higher returns than the government bonds, because they also expose you to a little bit of high risk compared to a government bond, because the government is the lowest risk borrower that you can have. So it's the best person to lend money to is the government, because their borrowing is backed by taxes, and if they defaulted on their debt obligations, it has dire economic consequences. So they always try to avoid as much as they can, and in their budget they always prioritize debt repayment, unlike maybe other people or even other corporations. The safest person to lend money to is the government, but now even some corporate entities, because they are also being backed by their services and by the revenues, you can also lend money to some corporate entities through what you call corporate papers. So they have better or maybe competitive rates. For example, currently looking at some papers in the corporate debt market, maybe in the private debt market, you can get papers that have a coupon of 19, 18, 17, or even 20%, depending with the risk profile. Obviously, the higher the coupon, the higher the risk as well. Then again, they are limited because the minimum investment amount for most of them is as high as 7.5 million. You can get some at 5 million, some at a million, but for most of them is 7.5 million, depending with the issuer. So most of these opportunities, you can get them through your asset management company, or maybe through your investment bank. But like I mentioned, they are reserved for high net worth individuals because of the minimum investment amounts. But essentially, they're one of the best source of passive income because you can get a high return. And most of the commercial papers, maybe some lenders can be safe, but obviously you have to look at the credit rating. So for all these commercial papers, usually rated by what we call credit rating agencies. So in Kenya, we have some of them. So all these commercial papers have a rating. So now you can check online at the ratings and what they stand for, but ideally you should look at the ratings so that maybe you can know the kind of risk that you are involving yourself in. Also check the fundamentals and the financials of the company that you are and that is issuing this commercial paper. You can look at how high their debt levels is versus their assets, and then their revenues and their cash flows as well, and the ability to repay any lenders, or maybe this commercial paper that they are issuing. But essentially, a corporate bonds or maybe commercial paper has a better benefit of giving you higher coupons, maybe higher returns than other fixed income instruments. That's it on passive income opportunities. I hope this video has been an eye-opener. We have ranked several passive income opportunities. I know I've not touched on some. Maybe I've not touched circles. So circles can also be a good passive income earner because you get the deposits and you also get the share capital giving you the dividends and the dividends giving you the rebates. But I've not touched them because circles can be a little bit complicated and they are best suitable for people who are taking credit, because the share capital is hard to get your money back, because you have to sell your share capital to a willing buyer for you to get your money back. And the savings in your BOSA account, which is the back office savings services account, which is the account that earns you the rebates, you have to exit the circle for you to access your money. So I don't want to rank circles here because maybe they serve other purposes. Then special funds as well. Special funds, for me, I see them as a better opportunity for capital growth, not passive income, because now it depends with whether you want to access your profits or not. Then money market funds as well. The people who can debate that they are there, but money market funds are just like a place to park your money for the short term. So they're just for emergency fund, sinking fund, and for savings, not really an investment asset classes, even though they can still act maybe as a passive income opportunity because you can be withdrawing the interest, but they still rank maybe lower from the asset classes that I've given. So that's my list. Let me know what you agree with me. Maybe you can give me your ranking on the comments section below. Let me know which ranking you agree with me. Let me know which asset I've ranked lower. Maybe you rank it higher for yourself. Maybe which asset class I've ranked higher, but maybe for you rank it lower. Those are the options for passive income. Thank you so much for watching this video. If you like educational content about money, personal finances, you can follow me on my socials. You can also consider subscribing to my channel, as I'll be releasing more educational content to keep you educated and financially literate, and to help you make more informed money decisions. So thank you so much, and see you in the next one. Bye bye.